first primitives on AMMs. How do we calculate this? Constant product AMM. And the constant product AMM, you just got this, it's all off this one simple equation. Token 1 here ETH and token 2 here USD equals a constant. And we'll call this constant liquidity squared. And it's called liquidity because it's, I'll show you. You just do some algebra and you can solve for ETH as a function of liquidity squared divided by USD and vice versa. And, and the thing is, if you trade, if I put one, USD in, then a certain amount has to go out that's mathematically, keeps this equation solid. So it's nice. That way, when Eve sets up the pool, she can walk away and doesn't have to do anything. It just automatically goes. It's automatic. So what's the price? Well, the price is how much, ETH comes out when how much USD comes out when ETH goes in, or vice versa. That's the two-sided price in these pools. And so, you can just take the derivative of USD with respect to change in ETH. And, you can do that by just saying, okay, well, what's USD? USD is equal to liquidity squared over ETH, the ETH. And what's that going to be equal to? Well, you take that derivative and you get, this number here, and it works out to, it's just the ratio of USD to ETH in the pool. It's a derivative, so it's, that's for epsilon amount of ETH added. But that's nice because it corresponds to our intuitive notions of the price. If I put in 1 ETH, I should get out 2,500 USD if the price is that. And the cool thing here is, you can use these simple equations, all from this one basic equation, and to work out, I can just do some algebra and figure out if I know the liquidity number and I take the square root of price, I know exactly how much USD is in the pool. And I also know how much ETH is in the pool. One's times square root of price and one's divided by the square root of price. And that's all you need to do to solve all these formulas to calculate exactly what, the impermanent loss or the convexity cost is for these guys. So there are 3 ways I'm going to show you how to calculate the P&L. Now, this is the simplest way, and I think the best way because it's easiest to do. And this is just the impermanent loss is basically defined as how much the difference between the pool value and your initial deposit value. The initial deposit value here has the subscript 0, and so the value at the new time 1. So this is like Eve's initial portfolio at the new price, and then this is the pool value here at this new price. And so, if we just rearrange, we can say, well, it's just the change in our USD amount for Eve in the pool times the current price times the change in our ETH for the LP. And the nice thing about this is, you can look at the event logs and just see how much goes in and out. And the event logs for Uniswap and Trader Joe, they just it's before fees. So this is all the money that's going to the LPs. And if you just look at, well, how much, went out and then how much ETH went in times the current price, that's going to be the LP P&L. And it's inclusive of fees, right? Because the fees are taken off the top. And this is the money going in pre-fees. So that's the first way to measure it. So what I can do is I look at something like, here's Uniswap's 5 basis point pool, and every day I can go and look at, on this day, how much, and I took this around noon, so whatever, but on this day at noon or so, how much USD in, this is times 1,000, basically 1.2 million went out of the pool, and 500 ETH went into the pool. Okay, and given the price at the end of the day, or at the end of this little sample here, I can calculate like the P&L. How do I do that? Well, I just look at, what's the cash flow? I just take the change in the, let's see here. I just take, this is exactly equal to, if 1.2 million went out, then, she lost that, but she gained 500 ETH in. Because this is adjusted by 1,000, I have to adjust the ETH by 1,000. And you can see the net of that is that pretty much flat. So she didn't lose, the LPs didn't lose any money that day. So fine. And so that's that's how you do the cash flow P&L. And if you calculate that, you can calculate it every day. You can do it every hour, week, month, whatever you want. So that's P&L calculation number one, and pretty straightforward. Now the second one is a little more complicated, and this is convenient to use too. It's related to the square roots of prices, and what you can do is, like before, you can say, well, what's the change in USD? Well, given we knew the formulas for USD in the pool, given certain liquidity and the price, we know the change in the pool is basically from the original price to the new price. And then if I can just factor out the liquidity, and it's just the liquidity times the difference in the square root of prices. And then for the change in ETH, it's liquidity times the difference in the reciprocal of the square root of prices, which, so you can just calculate this in. And the nice thing about this is then you can just look at the prices at the start and end of your period and liquidity and calculate the impermanent loss. Or this is the convexity cost. It's not a P&L because it doesn't include the fee income. And the cool thing here is you can also see how this impermanent loss is related to arbitrageurs' P&L. And we have to think, if Eve is being passive, the active guys net are, they're setting the price, and what are they doing? And, one way to calculate your P&L is, well, how much did I trade? If I bought, 100 ETH, my P&L, if P1 is like the final price, let's just say that's the market price, times my fill price, then that's how much money you made on them. And because you move the price on a trade, it's not obvious what the fill price is. In my simple example, I just said it was a static price, but it's a little more complicated. We know the fill price is basically how much USD over how much tokens, the absolute value. It's going to be negative, but we think of prices as positive. So, and how do you calculate the change in USD? Well, remember, it's this formula here. This is change in USD, and then this is the change in ETH. So if I know, I just put those numbers in here, and I have this ratio. And the cool thing is the liquidity cancels out. So all I have to do is do some algebra here. I can plug it into Wolfram Alpha now, so I don't have to calculate this anymore. And you get a square root of the product of the start and the end price. So that's my fill price. So the arbitrageur's P&L is just going to be, change in ETH, which is this number here, right? That's going to be that number. And then end price times the fill minus the fill price. And if you just do this math here, again, just throw it in Wolfram Alpha, and it gives you the exact same number, but the positive of the implied impermanent loss we calculated here, which is nice. Gives you an intuitive sense of what's going on. The impermanent loss is basically how much the passive LP is losing to the arbitrageurs, net. And so that's just how much money they lose on their portfolio, that impermanent loss. They should be making, in options, you make it via theta, the option decay. But in these AMMs, you get a fee. So, and fees are easy to measure. It's 5 basis points, and if 5 basis point pool, it'd be 5 basis points times whatever comes in. It's about equal to the absolute value that USD traded. So this is pretty straightforward to calculate. And then if I do that here, again, I can take, and I call this like the gamma method. And I put this in, I automated this in a program. I use Gauss, but you can do it in a spreadsheet too. And you just say, well, what was that formula? And then if I just take the, this square root thing. If I just take these square roots, so this is I take the dollar volume, the absolute dollar volume value every day. And here it's, this is dollar volume times 1,000. So that's 144 million at that point. And then I subtract out that thing I had. And so I have a liquidity number because, you get liquidity on every trade. So you have that number here because, remember, it's liquidity times that, difference in the square roots divided by the square root. And so you can calculate, well, what was the price at the end of the period and the beginning of the period? And you get a number. In this case, this day, not much is going on. They didn't lose much money. But that's how you calculate it that way. And so all you need there is price start, price end, and liquidity. Boom. And you're done. And that's another way to do it. And then, the final way to do it is using option theory. And, as I showed you before, you can you can replicate the payout of the pool with an option straddle and do it that way. But basically, the idea for an option theory is that, you know, uh, and this is the Black-Scholes partial differential equation. The main point is that dv dt is just the change, the time decay in the option. We don't have time decay, but we'll get back to that. The time decay has got to be replaced by fees here. But there's time decay, and then there's this convexity expected payoff. So, if you're an option seller, you're short the option, so you want the value of the option to go down. You're going to make money off that. So you're short it. So this negative amount's going to get smaller, which is good. Negative going down means you make money. Now, the convexity expected payoff comes out of the fact that when you have a convex, function, the expected value of that is going to be greater than, the initial value. And so, that's this here. Convexity cost is for an option with positive convexity, like you're long an option, well, the expected value of that is greater than the value at the current price. And with negative convexity, like what Eve has, the LP, it's going to be negative. And in equilibrium, let's just say this is going to it's going to be equal to the cost of the position, the riskless cost of putting on the position, because we assume you have to, if it takes $100 to put on the position, you got to pay for the $100, or it has an opportunity cost in equilibrium. On the other hand, if you get paid to take it because your hedge is generating so much cash, then you can actually lose money on the time decay and this convexity expected payoff and still be flat and make. So in equilibrium you make zero returns, which means that the theta, which in LP land and AMMs is going to be fees, has got to compensate equal to the convexity payoff that you're paying out to these arbitrageurs who are taking your money away. And so we can calculate this convexity payoff using these methods. The theta is very easy. It's just the amount coming in times the fee. Boom. Let's just assume that this interest rate is zero. It's, well, a couple years ago it used to be zero, but now it's more like 4 to 5%. But let's just ignore that for now. And an interesting thing is, it's important to remember you can calculate this. This formula is used to calculate the options, and it's Black-Scholes, and it assumes continuous time hedging. It has nothing to do with the frequency of hedging, and that's especially demonstrated by the fact that Cox-Ross-Rubinstein is calculates the same exact function for an option, and it basically assumes you don't hedge at all. So this assumes you hedge all the time because it uses Brownian motion, which is that stochastic calculus for continuous time. Nobody does. So hedging is good, but that doesn't affect the value of options. It just affects your capital and risk management. But the bottom line is, you have negative convexity, you need positive theta. You need lots of fees. They have to be equal, all right? If you don't make more money than you're paying in convexity, you're hurting. So let's go. Can we figure this out? Well, yeah, we can, because we know what's the value of this portfolio for Eve, the LP, and what's her delta. Well, the delta is the change. The value of the LP is basically 2 times liquidity times the square root of price, and you just follow the algebra there to calculate it. We got these values from the earlier slide, and the delta is simply ETH, the amount of ETH in there, which makes sense. That if Eve has 100 ETH in the pool and 2,500 times $100, well, her sensitivity to a change in the price of ETH is going to be the amount of ETH in the pool. Makes sense. Fine. And then what's the gamma? Gamma is the change in delta. And the change in delta here we can calculate because we know what's the value for the ETH in the pool? Well, it's liquidity over square root of price. Well, if we take that derivative with respect to P, we get this number here, which is negative gamma, times 1/2 times all this business here. And the bottom line is negative liquidity over 2 times P to 3/2. So that's just the gamma, however. Now, the convexity payoff in the Black-Scholes is gamma over 2 times the price times the variance. So you just do the algebra on that sucker, and you get this payoff here. Negative liquidity, we can measure that. Square root of price, easy. Volatility, you can use, I just use day over day. That works fine. I try to use minute by minute. It doesn't matter. They're all about the same. And divided by 4. Another fun thing to do is, you can say, well, if I take this convexity cost or payoff, well, what's the LP pool value? The LP pool value is 2 times liquidity times square root of price. So you get this neat formula of variance over 8, which is, it's kind of fun. But the tricky thing about this whole approach is liquidity, because liquidity, whether you're looking at it over a day or a week, it's not constant. So that makes it a little trickier, and that's really why I prefer the first inflows and outflows approach. But we can see how we calculate it here. Here if I just take the fee revenue, obviously this is like the theta, just absolute dollar amount traded times 5 basis points. And then it's times H, which is liquidity, all right? H, and liquidity. And then times the square root of price, good. And then I just took the dollar change that day and I squared that. Okay, that's my variance, divided by 4. And I get that number. And then, remember I showed you that cool thing with the H. You can also just take, the volatility that day divided by 8 and times the market value. And, well, they're mathematically identical. So they give you the exact same number, but it's always fun to do things 2 different ways. But the bottom line is that they're all about the same. If I were to look at these, in different ways, here's the, Anyway, you can use either of these approaches. You can see how they mesh. Here's the cash flow formula, gives, this is 67. The units here this is average per day. This here is, these are in thousands. So $67,000 per day. It was a lot more before because they used to be bigger before. So right now it's only 55,000. But using that gamma method with the option theory, you get 52,000. And then using the square root method and liquidities, you get 50. So whatever, they're close. They're all similar. They're all giving the same result, and the similar result is they're all bleeding money. Ouch. So what do we do? Well, one tricky thing is, might think, well, this is driven by LP shenanigans of some